Bear markets can shake even the most seasoned investors, but they don't have to spell disaster. In this video, we're diving into bear markets, how to survive and profit from the downturn. You'll learn strategies to protect your portfolio, spot opportunities when others panic, and build resilience that pays off when the market rebounds. Today, we will talk about bear markets, how to survive and profit from the downturn. So before we get started, make sure to hit that like button, also subscribe to my channel. Understanding what a bear market really means. A bear market is more than just a drop in stock prices. It means the overall market has fallen by at least 20% from its recent high and remains depressed for a significant period. This is often a sign that investor confidence is low and the economy might be facing challenges such as slowing growth, rising unemployment, or other troubles. Bear markets are natural in the economic cycle and can last anywhere from a few months to a couple of years or longer. During this time, investors often feel anxious as their portfolios lose value. But knowing that bear markets are a normal phase in investing can help you stay calm and make better decisions. They are not the end of investing, but rather a period of adjustment that will eventually lead to recovery. 2. Bear markets cause fear and panic, but emotion is your enemy. When stock prices start falling quickly, fear spreads rapidly. Many investors sell their holdings in a rush, hoping to avoid further losses. This panic selling often pushes prices down even more, sometimes beyond what the economy or company earnings justify. Acting on emotion during a bear market is one of the biggest mistakes an investor can make. Selling out of fear locks in losses and prevents you from benefiting when the market eventually recovers. Staying calm and sticking to your investment plan is difficult but essential. Remember, successful investing is as much about controlling your emotions as it is about picking the right stocks. 3. Keep a long-term perspective to ride out the storm. The pain of seeing your investments fall in value is real, but history proves that stock markets recover and grow over time. The best approach during a bear market is to keep your eyes on the long-term goal, whether it's retirement, buying a home, or funding education. Selling during a downturn means you miss the market's rebound, which often comes suddenly and sharply. Many of the best days in the stock market happen right after big declines. Staying invested allows you to benefit from these rebounds. Developing patience and discipline helps you ride through the storm rather than getting swept away by fear. 4. Diversify your portfolio to reduce risk. Diversification means spreading your money across different types of investments, industries, and geographic regions. This helps protect your portfolio from big losses in any single area. In bear markets, some sectors or asset classes may fall hard, while others hold up better or even gain. For example, bonds typically do better when stocks are falling because investors seek safer assets. Real estate and commodities can also provide balance. While diversification doesn't eliminate risk, it cushions the blow and makes your overall portfolio more resilient. Reviewing your asset allocation regularly and adjusting as needed can keep your portfolio aligned with your risk tolerance during tough times. 5. Look for buying opportunities in beaten-down stocks. Bear markets can be scary, but they also offer one of the best chances to buy quality companies at lower prices. When prices fall due to fear or short-term problems, some strong businesses become undervalued. These companies often have good management, stable earnings, and solid financial health. Buying these stocks during a downturn can lead to big gains when the market recovers. This approach requires patience and careful research. It's important to avoid chasing hot stocks or risky investments that have fallen sharply for good reasons. Instead, focus on businesses with lasting value that the market has temporarily overlooked. 6. Avoid trying to time the market. Timing the market means trying to predict the exact moments to buy low and sell high. While this sounds simple in theory, it's almost impossible to do consistently. Most investors who try to time the market end up missing the best days of recovery, which hurts their returns severely. Instead, a disciplined and consistent investment strategy works better. Dollar cost averaging, which means investing a fixed amount regularly regardless of market conditions, reduces the risk of investing a large sum at the wrong time. Over time, this strategy smooths out the ups and downs of the market and helps build wealth steadily, even during bear markets. 7. Maintain an emergency fund to avoid forced selling. A bear market often coincides with economic challenges like job losses or unexpected expenses. If you don't have enough savings, you may be forced to sell investments at low prices to cover your costs. This locks in losses and damages your long-term wealth. An emergency fund with 3 to 6 months' worth of living expenses acts as a financial safety net. It allows you to cover bills and emergencies without touching your investments during market downturns. Having this cushion reduces stress and gives you the freedom to wait for markets to recover instead of selling at the worst times. 8. Use tax strategies to your advantage during losses. Bear markets can be an opportunity to use tax loss harvesting. This means selling investments at a loss to offset gains from other investments, reducing your tax bill. You can also use these losses to offset future gains, helping you keep more money when your investments bounce back. Tax loss harvesting requires careful tracking and understanding of tax rules, but can improve your after-tax returns over time. While it won't stop losses, it makes them less painful. Consulting a tax professional or financial advisor can help you make the most of these strategies. 9. Bear markets often lead to new economic opportunities. While bear markets can feel discouraging, they also reset the economy and pave the way for new growth. Weak companies that cannot survive often fail or get acquired, making space for stronger firms. Economic downturns push innovation and efficiency. Some of the biggest companies and trends in history emerged from tough economic times. Investors who can spot these opportunities and position their portfolios accordingly can profit when the market moves up again. Staying informed about economic trends and emerging industries helps you take advantage of these shifts. 10. Learning from bear markets makes you a stronger investor. Every bear market is a chance to learn about risk, discipline, and patience. These lessons build your confidence and improve your investment skills. Experiencing a downturn and coming through it teaches you how to manage fear and avoid mistakes. The knowledge you gain helps you prepare for future market cycles and unexpected events. Investing is a lifelong journey that includes ups and downs. Bear markets may be difficult, but they are also opportunities to grow stronger, wiser, and more successful over time. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.